Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. On April 18th and 19th, Fidelity Investments Canada hosted Focus 2024, a two-day event for advisors featuring insights from Fidelity's portfolio managers and subject matter experts. For today's podcast, we're bringing you a discussion from this event featuring portfolio manager Ramona Persaud, sitting down with host Glen Davidson. Ramona manages several dividend strategies, including Fidelity U.S. Dividend Fund and Tactical High Income Fund, among others. Morningstar has described Ramona as, quote, "She never rests on her laurels. Instead, her drive to improve, paired with the analytical rigor she applies to her process, have led to continued excellence." We'll hear today how she manages her several dividend strategies with a continued focus on downside protection. This podcast was recorded on April 18th, 2024.
You're a great example of how students, think back, should be really keeping their eyes and ears open when they're in school and when you're working about what lies ahead and be open to different options. You are an engineer by education, thought about doing your PhD, so you could be Dr. Ramona, and you were working at Morgan Stanley to pay for your books. And you said, this financial services stuff is pretty good. And long story short, ended up in 2003 starting at Fidelity, and I think it was small cap paper and packaging, one of the more exciting groups of sectors to cover. And that's led to some wonderful things, lots of accolades, and you become a portfolio manager and a very successful one. Now that's led you also to a lot of learnings over the years. You work with wonderful people. They've learned a lot from you. You've learned a lot from them. But it's taken you down the path of a value orientation, a dividend orientation from an equity standpoint, and a keen eye on volatility. Yep. What is the path that you want to take all of us as investors on?
Wow, that is...
That's it. That's all I'm going to say.
I'm just so impressed with the question. I need a moment to process it. I guess what I would say is investing is, of course, all about returns, trying to maximize returns. But what I think differentiates the way that I do it, maybe based on some of the history that you just gave, is, of course, I want stellar returns. But one of the things you learn when you're studying science and engineering, and probably lots of other things, but for me, one of the things you learn is essentially there's no free lunch. So what cost do you have to incur to get whatever reward? And this is something that we talk about with kids all the time, right? What cost do you have to incur to get the reward that you're looking for? So if the reward is the return, the cost for me has always been the risk. And risk can be defined in a lot of different ways. And I think every investor, irrespective of the style, has this idea of balancing risk with reward. So the risk in my mind is volatility. And that might be maybe, I don't want to judge volatility as risk, but the reason volatility is the primary risk in my mind is twofold. One, when your return stream has a lot of volatility in it, essentially, and all the research or data prove this out, investors churn. So investors get really nervous at peak points of volatility, and they will typically buy and sell at the wrong times. And so their ultimate return profile will look actually very different from that of the underlying funds that they're investing in. So the fund might be just fine because the fund manager is not churning. But if the investor is churning on the back of volatility, then their returns disconnect from the funds that they're investing in. And that to me is sort of not what we want. So we want the end investor outcomes to be aligned with the fund outcomes. And for me, the answer there, the bridge between those two, is trying to be very mindful of risk in the form of volatility. So that's the first reason that volatility is, to me, the cost that you incur for the return. And the second reason is the more volatility you have in your return stream, the worse your compounded returns. So volatility is essentially a drag on compounded returns, compounded being geometric returns, not arithmetic returns. So if you sort of add up or average returns, volatility doesn't really show up as the insidious cost that it is, but investors realize compounded returns. And so when you compound returns with a lot of volatility in them, you essentially really create this drag like a car to the extent people like driving. And, if you think of like cars being designed aerodynamically in an aerodynamically efficient way, that is to reduce your coefficient of drag or your coefficient of friction. Same thing with the fund. So what I'm trying to do is really have as smooth a return journey as I can in the context of a long-only equity portfolio. So in more concrete terms, that will typically translate to a fund that is lower beta in profile. And so I'm trying to maximize the amount of return I can get for sort of a low beta profile.
So Alex Cabrini would correct me on this, but I've seen about 5 Cybertrucks since I've been here, and they look like big blocks. Yeah. So there's a lot of resistance there, high coefficient of drag, all that sort of stuff. So you're not a Tesla truck.
I'm going to say I don't know enough about, I haven't studied those, but I saw one too, and I was like, I don't think I would enjoy driving that.
No. Now, from a fundamental research standpoint, tell us about, as consumers of information, we're all caught up, I think, on the fact that media comes at us only about interest rates. What's going to happen? Are they going to go up? They're going to go down? Everything else. And stocks seem to be moving, people would think, because of that. But there's fundamental research that we need to apply, and that's something that you capitalize on.
Absolutely. So my process and everyone you will hear from that invests in individual securities is very fundamentally bottom-up driven. So first and foremost, we're looking at individual companies. And I think what really differentiates us is we've got, 150 analysts all across the world just looking at companies. And so at its core, we are interacting with all of those people, seeing companies every single day and consuming the research, the work that they are doing in order to get a view on companies. My process tends to be what I call mosaic, which is I like to take that input. I like to take a lot of different inputs to come as part of my decision process in everything. And so fundamental is the biggest input, but then because I'm an engineer and really like intensive analytical processes, I love quantitative analysis. So I like to combine it with a lot of quantitative work, statistical work, technical research, every single kind of deep analytical work I can absorb to create a mosaic, which is sort of the art of the process, to then come to investment conclusions. And I find that is especially helpful in global investing because you're looking at the entire world. And I don't know if that's 10,000 stocks, let's say, 10,000 reasonably liquid stocks that you can invest in. You want to be efficient. You don't want to be like going through 10,000 stocks one by one. And so the way that we found efficiency over, 15 years we've been doing global is a lot of quantitative, like building alpha models, building statistical models to just really try to parse through that universe to figure out where the best hunting ground is.
When you were an analyst covering paper and packaging in the small cap space, how did you get your credibility to where you needed it to get to?
At the time I thought, gosh, small cap paper and packaging, nobody wants to buy these stocks. And, that's for good reason. So what I realized quickly is when you first start out, doing something that cannot do much harm is really helpful. So it was incredibly good from an analytical perspective. I could just really understand that universe, but we didn't own a lot of it. And so if I made a lot of mistakes as this new analyst, I was not going to harm our performance. So it was this incredible risk reward. The risk was very low because no one was owning it. And it was too small to really hurt any funds, but the reward was huge in that I was learning a lot. So that was an incredible first assignment. And then that helped me to understand cyclicals, how to invest in highly, what I call deep cyclical companies that are extremely sensitive to the macro. And then from there, I was able to cover more and more meaningful cyclicals. So from there, I did housing, which was extremely impactful to the funds. Like we got the housing boom on the way up and the housing boom on the way down. And from there, I did financials. So paper and small cap, paper and packaging was an incredible foundation for understanding cyclicals and value investing. And then getting us into housing stocks at the right time, getting us out, and then getting us out of financials, I totally attribute to small cap paper and packaging.
And that's how you got the ear of the portfolio managers. What do you require from the analysts now? You have hundreds of them that are coming at you, and you're a great processor of information. But how do you challenge those analysts?
So I realized at some point early in my portfolio manager role that, so I'll be a little bit vulnerable. There's this way that I can be very intimidating. And so, because I don't just want people that understand companies fundamentally. I want them to be part of my mosaic process. Yeah. So I want them to elevate their thinking. And so for the last 10 years, I've been trying to, I think this is part of the mentoring and trying to develop really strong analysts. Okay, fine. You know your company really well. I want you to understand and to contextualize what that company looks like against its industry, its sector, the market, and the world. And so I have found a lot of pleasure, and the analyst team that I work with very well, a lot of pleasure in just elevating their thinking into portfolio construction land, where when they become portfolio managers, their skill set is really sharp because they've spent a decade or whatever just thinking about how to contextualize stocks in a mosaic way. So initially, I realized, it's intimidating to come in and talk to someone who's extremely analytical and wants their models to be really tight. Mm-hmm. And then, so I learned, there's so much learning in this job beyond just investing. There's a lot of people learning. I learned how to be disarming enough, which was hard, such that it made the conversation more welcoming. And I learned how to teach analytical processes in a disarming way. So that was a whole new skill set, if that makes sense.
A quick aside, if you did pursue your PhD, was it to be a professor?
No.
Okay, well, no connection there.
Yeah. I wanted to be a research scientist. I wanted to solve air and soil pollution.
Got it. Capitalization bias today.
Yes.
What are you focused on?
Okay, so stepping back, mosaic process. It's one thing to look at stocks individually, but when you look at stock by stock by stock, you don't really, and you just sort of, start bottom up. You need to be able to connect it from the top down. And so what initially one of the, if you focus too much on fundamental bottom-up research, one of the mistakes that you can make, or one of the mistakes I made initially, was to not tie it back to the top down. And one of the great benefits of having covered financials and financials globally is you are forced to understand macro. So you could do top down and bottom up. The reason I say that is it is wonderful to do individual, and this is what I try to impart to analysts as well. It's wonderful to do individual stock research. It's amazing to just look at something. One of the frameworks I use is valuation spreads. So that's essentially dispersion between all different sorts of slicing and dicing, parsing of the market. So one of the ways people do dispersion is between expensive stocks and cheap stocks. I love to look at the most expensive parts of the market and the least expensive parts of the market by market capitalization or by sector. You could parse it any way you want. Mm-hmm. And so the typical way to do it is within, say, large cap U.S., which is the area that I would tend to play in. What does the difference between the most expensive stocks and the cheapest stocks look like today? And compare that difference to historical difference over time. And then you can sort of normalize that difference. So figure out that difference in a standard deviation way, just so that it makes it easy to understand how today compares to the past. You can contextualize today to the past. So when you do that today, and for a long time, I think, Andrew, you were talking about this, you have to look harder. There's not a lot of dispersion in the marketplace. And dispersion is essentially a measure of fear. When the most expensive stocks and the least expensive stocks are wider than usual in their valuation difference, that's telling you there's a lot of fear in the marketplace. People are crowding into the most expensive stocks tend to be the safest or the most secure or the ones that people feel the most confident in. And so when the difference between their valuation and the cheapest is wider, it typically means everyone's crowding into safety. So that typically means that the cheapest stocks just have a lot more fear in them. And that's when, if you're a value oriented person, that's when it gets really exciting. So that dispersion today and over the last few years relative to long-term history has just been nothing. It's been like average. And I'll give you an example. In the height of COVID, so March of 2020, before we got the turn, that dispersion was like 4. So that number is what's called a Z-score, 4. In the global financial crisis, that number was 7, which is like crazy. Today, it's like 0. So inside of, this is back to your capitalization question, inside of large cap US, I just can't find that much fear. So then you have to go parse it a little bit differently. So then I look at like smaller cap and I look at international and I look at different sectors. When you go down in cap, there is more dispersion. And so what that has signaled to me, and of course we're doing bottom up stock by stock, but again, if you're just looking stock by stock, you can't see these patterns. So what that signaled to me is we've got to go a little bit smaller. So in my positioning the last 6 to 9 months, as this dispersion has opened up inside of capitalization, my tendency has been to go smaller in terms of what I'm interested in. The other place where we're finding dispersion, so I just mentioned large cap US, is outside of the US. So if you look at dispersion, ex-US, as I like to call it, that's wide across the board. Inside the US, if you slice by sector, you can get some dispersion in higher beta sectors. So financials right now has the widest sort of spread, which means the most fear. Energy has a bit. Consumer staples, which is very, very secure and safe, is really narrow. So that's just really interesting signal to me about essentially where the hunting ground for stocks is most fertile. So we just don't have a lot of opportunity in safety or lower beta or large cap or US, and everything that's not those. There's just a lot more opportunity. There's much more dispersion in every single sector outside of the US. So that's where I've been orienting.
So 2024 has become a little bit more of a not volatile, but you've taken on more beta in 2024.
Right. Well, not
relative.
Just this, coming into this year. So not just this year, but sort of the last 3 to 6 months of last year. And again, from a top-down perspective, essentially the macro got a bit de-risked, right? The interest rate picture got less unpredictable, which is different from more predictable if you're a nuancey person. So less unpredictable. So all of a sudden, you could start to really think about stocks as opposed to interest rates. Like ever since coming out of the global financial crisis, it's been all about the dispersion in rates that has just created this this fuel for long duration assets. And that has been just so difficult. And then we had this period of, a great period for value when rates got higher and the macro sort of clarified more, and then that's come back. So I think all of a sudden now with a more de-risked macro, we can start to really invest stock by stock. And I'm seeing that from a bottom-up perspective too. In smaller, so not in mega cap, but in large and mid cap, there's just a lot more opportunity.
That's exciting.
Really exciting.
Now, you run funds for U.S. investors, you run funds for Canadian investors, you run them from a U.S. perspective and a global perspective. And you just mentioned about how global gives you so many more opportunities and the teams around the world. So that's wonderful. Canada's part of that. What do you like in Canada?
I have owned the oil sands companies for a long time. Coming out of COVID, as you all know, especially being Canadian investors, you know what happened to the energy sector stocks in COVID with this incredible distortion in oil prices. So that created very attractive valuations at that time. You could get inside of the energy sector, you could get the lowest beta parts of that sector for really beautiful double-digit free cash flow yields, which is unheard of. So at that point, I added a lot of energy, like sort of the around then and the months after, added a lot of energy because at the time as well, the free cash flow profile of that sector just looked very attractive. Essentially, the capital expenditures for that sector, I like to look at capital expenditures per unit of sales, which sort of tells you how much they're investing for every unit of sales dollars, if you will, just was at a trough. And it was bouncing along the bottom, which is essentially very positive for free cash flow generation. And so if you could get 1 unit of free cash flow for this incredible free cash flow yield, that's incredibly bullish for the sector. And so that was sort of the 2 to 3 years coming out of COVID. Those valuations have corrected, but all through then I owned the oil sands companies, still own them, but just in smaller size because the valuation is not quite there. And then I own some of the great consumer businesses in Canada. So I own Metro, the food retailer. I own Couche-Tard, which is this this incredible C-store operator with all kinds of ways to win. And there are times, So Couche-Tard has this interesting dynamic right now where there is incredible fear and skepticism in fuel retail. And so there are times when they report, and I think this happened recently, they report like squishy fuel retail numbers, and the market just goes deep into fear and believes that that business is going to go to zero. And then you can get that stock, which is doing a lot to counteract that headwind. Then you can get that stock for a really beautiful free cash flow yield. So every time that happens, I add more. Exceptionally well managed. One of the best capital allocators I have come across the world. Like, those guys know what they're doing. So when you get that kind of business profile and you believe that the management really knows how to allocate capital, especially against structural headwinds, and you can buy that for like under 15 times earnings, I just live for that. So that's a really good example in Canada.
And getting out of Canada and staying out of the U.S., maybe you could give us some examples globally that have been interesting to you that are in the top 10, Sean. One, for example, is Taiwan Semiconductor. They just had a good report. That must have made you feel good, assuming it's still in the portfolio. Yeah. Can you talk maybe about that and as a play on AI and some other names?
Similar to Couche-Tard, and I'll abstract it away to what I'm looking for. Taiwan Semi, you would never sort of think what makes Couche-Tard and Taiwan Semiconductor similar businesses. And essentially, it's this idea of a moat. So protection around the business, just like protection around a castle, if you will. Morningstar is a big believer in this moat concept. So a company in an industry where the company manages to create this buffer, this absorption capacity for risk in the industry by having some sort of competitive advantage and just taking the gains from that competitive advantage and reinvesting it in the business. And that's the abstraction for the typical company that I try to own. So across sectors, I can find companies like this. Couche-Tard is an example. Taiwan Semi is an example where essentially they have built incredibly efficient semiconductor manufacturing processes. They've taken the cash flow off of that, and instead of giving it all back to investors, they've reinvested it in keeping their lead. So they have sort of an advantage that they developed. So Taiwan Semi and Intel, let's go way back, like 3 decades ago, maybe let's call them maybe equal. And Taiwan Semi just kept creating this like tiny lead, right? By being the most efficient, the most, the better capital allocator, the better reinvestor of capital, and this tiny lead. And then they just like, by doing, it's what I talked about in the fund. I view these guys as really good, essentially capital allocators, like portfolio managers, taking a small advantage, which is like a beautiful return, and compounding, letting it compound with an eye on the risk that is incurred to get that return. And so they just kept compounding the cash flow from their processes, and it created this massive lead against, say, Intel. And the thing with semiconductors is the technology changes so fast that you really have to keep up with your R&D, let's say. So all of a sudden they have what we call this incredible moat around the business, an incredible process with capital allocation that they've deepened from just letting it compound. And there are times, so again, like Couche-Tard, when the cycle looks like it's going against them, when demand for the product gets squishy, as we've seen the last couple of years, and the stock goes to like 15, 16, even 17 times earnings, and you can buy that sort of capital allocation for a mid-teens multiple in a market that is like 20 times, it's incredible. There was a time like a couple of years ago, Taiwan Semi got to like 12 times earnings. It was one of these moments that you just wait for.
Yeah.
So that
was a good day for you.
Yeah, but period. And you're scared, right? There's a lot of fear because that multiple is telling you that the business is broken when it's been trading at like 23 times the year prior. And you just have to go recheck in with the company, recheck in with the entire sort of supply chain or food chain, if you will, around the company to understand if your thesis is still intact. And then ask yourself, like, is this a valuation that I will like double my position size?
And you're not just asking yourself, because you're surrounded by wonderful portfolio managers and talent at Fidelity. You're not in a silo.
That's right.
Will Danoff and Joel Tillinghast, I think you sit right by them.
Yes.
I see a lot of LinkedIn posts where you're together. Yeah. Will, at the Vision event in Toronto, when we were in the green room, he's like, where's Ramona? Is Ramona here yet? So I know you have a very good relationship with a number of people, but them included. What have they learned from you? I'll bet you've brought some interesting insight to them.
How do you ask me that question? I don't know what they've learned from me.
Sure, you've got a good answer. What have you learned from them?
That's an easier one to answer. All right. So I like to say that, and a lot of us think this, I say it in my way, growing up in the time of Will and Joel is like the greatest privilege as a professional and as a professional investor that I could have ever dreamed of. And I think it's not, this is just my way of putting it. We all feel this way. This sort of generation of fund managers after Will and Joel, like, whoa, and Steve Weimer as well. And, but those two are sort of the celebrities. And for me, specifically, more Joel than Will, because his investing style resonates far more with me. What's been incredible is the organic, natural interactions you have. So Joel and I, pre-COVID, would always be making tea in the kitchen at the same time throughout the day, 5 times a day we go there. And we run into each other and we're both pressing the button for the hot water, which takes a really long time. And so there's good conversation that happens from that. And what's happened with Joel is not just talking stocks and this way of him imparting the way he thinks about companies, but we became friends. And so we talk about gardening and flowers, because I love flowers, and he gardens a lot.
He's a hibiscus guy.
He's he's got everything, yeah. And his school, his house is 2 doors down from Tara's school. So we talk about the neighborhood. So we would just talk a lot about life, and there's something about talking, having a friend and talking life that strangely, this might sound weird, that deepens the way you think about investing. Because honestly, I believe that my style as an investor is inherently tied to sort of the way I think about life. And so, sharing ideas about how we think about life with Joel has, I think, deepened me both as a person, as an investor. So that's been my experience with him. I don't know what they would say about what they've learned from me. I think the obvious one is this is not a very diverse business. There are not very many women. There are not very many women of color. There are not very many women of color not born in the U.S. So I think perhaps everyone I work with has just greater exposure to the idea that people who to diverse perspectives, diverse experiences, people who might look different and have different backgrounds can do this work well too.
You're so humble. They've learned a lot from you.
Thank you.
We'll shift gears.
Yep.
We've got a first question coming in on the screen, and it says, do you see a shift away from growth and back to value occurring in 2024? And what exact date? No, it doesn't say that.
I don't know. It's really hard to make that prediction, because what has been the case in this idea of growth versus value, let's make that more concrete, maybe. Long duration versus short duration. So value tends to be, and what we mean by that is cash flows that are way far out into the future, so far that you just don't know where they are. So that's what we tend to call growth, hypergrowth, and cash flows that are right here. So that's what we tend to call value. And that has been entirely a function, maybe not entirely, but mostly a function of interest rates. So depending on where the rates are, right, it'll either fuel your faraway cash flows or not. And the way that I framed it is, coming out of the global financial crisis, there was just so much monetary policy. And, Dave Wolf, this better than anyone, being a central bank person for so long. When you speak tomorrow, definitely disagree if you think this isn't right. But there was so much monetary policy, monetary involvement to try to save us from the global financial crisis, that it really distorted rates and created this, I said it before, is incredible fuel for long duration. And then we got into COVID, and when we got post-COVID into the supply chain stuff and inflation, which so essentially maybe normalized rates more, which then brought us back to shorter duration and had us bounce back into value, if you will. So now the question becomes, I don't know, where do rates sort of settle out at? And I never try to predict that. But to the extent that we end up in a less distorted place with rates, the way I think about value versus growth or very long versus very short duration is this idea of like maybe mid-duration. So if we have a slightly more normalized rates, we're in this place, I think, where it can be more stock picking oriented. So the minute you get anything distorted, it becomes about themes and top down. And I felt as if it has seemed as if for the last, we're in 2024, for the last like 10, 12 years, it has been very exogenous or very macro driven, the markets, with the biggest variable being rates. And what feels quite encouraging and exciting is if we get some normalization in that again, we can start to stock pick again. That's what this year has felt like. So this question about value versus growth, I actually think we can stock pick enough that it's not a huge skew to one factor or another, underlaid by a more normalized, perhaps, rate environment.
Great. So that was from a style perspective. Let's talk about dividends because that's what you know and love so much. What does the current interest rate environment and potential future interest rate environment mean for dividends today?
Yep.
And then we'll dig into
so COVID, the pandemic took away, was such a shock that a lot of companies had to remove or reduce dividends. And what has been good coming out of that pandemic environment is companies raising their payout ratios again. And if you can get this combination of a payout ratio that's going up with a valuation that's not too steep, that's a beautiful combination for alpha odds. So your alpha, your stock picking return can be really strong. So today we still have some companies that their payout ratios are still quite low because of having taken away dividends or really reduced dividends in the pandemic. So Disney is a really good example. What I'm finding a lot to that last question about value versus growth is I'm finding a lot of special situations that are a bit smaller in cap. So not these like big mega cap, high quality companies, but tons of what I would just put into this bucket of special situations, spin outs, turnarounds, all kinds of things. So Disney is an example of this, where they took their dividend away and it took a while and they had this management team that was really mis-executing. And then so the old management team came back. And the idea here is execution across all of the businesses can start to improve. If you do, and if you build out the model and you look at what they can earn based on better execution, the stock valuation on those earnings is actually quite interesting. And so you've got the good valuation with the payout ratio, which is very low, the payout ratio low and starting to come back. That tends to be, again, excellent alpha odds. So that's an example of what I'm looking for in terms of this question about dividends. Looking at companies where payout ratios are still depressed, coming back, combined with good valuation.
Excellent. Where do you fit, be it your U.S. portfolio or your global angle? Where do you fit in a portfolio? Why should everybody have some value-based dividend stocks within their portfolios?
If what I've said resonates with you, which is that you're not just looking to juice your returns, but you care about the risk that is incurred for those returns. And you care because you want your clients to ultimately experience returns that are as close to the underlying funds as possible. And you want the returns of those underlying funds, the compounded returns, to be the best that they can be. So you really care about volatility. That is what this process is. That is what I'm trying to do. So I'm trying to give you, obviously, alpha, but alpha that considers downside protection and that gets you some income. So very risk-sensitive alpha so that the end investor can have a really good experience. So to me, that's why you would consider global stocks with some dividends, with some value in any portfolio.
We've got time for just a few more questions. So I just want to go back to the global aspect.
Yeah.
Company meetings are happening at Fidelity. You're traveling a lot to see companies. You have all the access that you need. How are you handling all of that these days? Any recent conferences in Boston?
Good question. We actually hosted we have this beautiful facility in Boston, and we did this thing where we hosted maybe 40 companies over the course of 50 companies over the course of 2 days, right on site.
At 250 Summer.
At 245 Summer.
245.
And we invited our competitors. So we invited some of the other big asset managers. They came to Boston. And literally in 2 days, I saw 20 to 22 companies. So that's literally 8 a.m. to 6 p.m. back to back, seeing companies. The conversations were deep, insightful. The companies kept commenting that these were incredibly strong meetings because of who attended. It's Fidelity, Wellington, T. Rowe, Fidelity in the UK. So really long-term oriented investors. And what was great is I saw, I don't know, probably it was mainly consumer companies. So a good 25% of my portfolio. And then the prior month, I had seen all of these other companies coming through. So it's been wonderful to come out of COVID, have companies come back through and just keep refreshing on my portfolios by seeing them. And everybody does it differently. We have so much autonomy in how we do the job. So there are people who like to just travel and go out and see companies. And I did that when I lived in London and worked on the Diversified International Fund. I went all over the world and developed relationships with all of our analysts and saw every single company you can imagine. And so now I don't need to do that as much. I just see them when they come in. I have a very good idea of what they are, what they do. I know them already. So you do the job in whatever way suits you.
And then you also have that communication with the analysts globally as well. So it's very efficient for you.
Exactly.
Which is good. I'd love to ask you a question as we conclude that kind of connects with what we talked about at the beginning, which was examples that you've provided for someone like Tara and others. You're a multiple award winner. You've received many accolades. You've even been up here on the Golden Globe stage now, which is great. And you've been a mentor to so many people and an influence on so many people. Something that you've coached a lot of young people on, I thought was very interesting. And it had to do with always looking for mentors and sponsors within your young ages, but also when you're in your working, so education, but also in your working life. As a parent, and for all the parents here, could you talk about that and what that means? It's a great learning, I think, for young people.
Yeah, so when we talk about professional development, the most obvious thing to talk about is mentors, looking for mentors and trying to learn from mentors. And that's definitely important. And one of the great things about the way we do it at Fidelity in research is it's such a big place that, we assign a mentor, of course. But what I found through the course of my career and lots of people is you naturally resonate. So like Joel is probably one of my deepest mentors, but so many people. What you find are just the people that you naturally just vibe with. And you spend a lot of time with them and they shape you. What is also on the mentorship angle, what is also really important that is much more subtle is the people who are new and just starting, that there's like a reverse mentorship. So I learned so much from all of the people who are just starting out because it's fresh eyes. Like one of the most important things you can do when you're looking at a complicated problem to solve is to have fresh, really bright, intelligent, dynamic eyes on a situation. So making sure that you stay open-minded. Like my kids, Sarah, I will embarrass you a little bit. My kids teach me so much by just looking at something with completely fresh and different eyes. So the same thing at work as well, right? Like making sure I understand that all of the newer people have incredible value to add. So that's on mentorship. And then the next part is really important that we don't talk about enough is this idea of sponsorship. So sponsorship is the idea that when you are not in a room, but there are really big decisions being made, people decisions being made, there is somebody in the room who can represent and speak for the people who should have more responsibility. So one of the things that I've taken really seriously as I've gotten into these rooms, and that as I've had people who have been in rooms speaking highly of me, is to do the same for others, to highlight the work of the quiet analysts. Like I'll give you an example. The current person who is based in London covering European telcos and telco stocks is really bright. He just started. He's this kid from an immigrant family in the UK, grew up very humbly, very modestly, went to Oxford, which is already a big deal considering his background. And just like he's 1 year into the job, and I sat down with him and I was like, his instincts on these really boring stocks that, by the way, is like small cap paper and packaging, nobody's going to care about, nobody's going to buy. His instincts are like somebody who's been doing the job for 10 years, right? And nobody's going to notice him. And it will take a few different assignments for him to get an assignment that anyone cares about, to really notice how strong he is. And so I met him and I was like, okay, everyone needs to know. And so when I went and I wrote to the whole team and said, look, like, we need to look at this new analyst's work. Here's what I saw when I met with him, making sure you're speaking about people when they can't speak for themselves, when they're not in the room where big decisions are being made. And so what I said is, he needs a really strong assignment that is going to impact the funds like right away. And so a few of us are now working on that and doing the same thing for people. He's really quiet. He's very introverted. So the introvert also is culturally not celebrated, right? There's a great book on this called Quiet by Susan Cain. Believe it or not, I was deeply introverted, still am, when I started. So speaking up for those people, I think, makes a huge difference. And it's beneficial for the end investor to get eyes on his work and to get those ideas into the funds. So I get very excited about this.
Look at all these messages coming up about wrapping up. Thank you so much for life lessons. Thank you so much for investing lessons. You made some really compelling cases today. Thank you.
Thank you for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. Thanks again. See you tomorrow. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.